Hello and welcome to Technical Analysis 101, brought to you by TackleTrading.com. Hello and welcome back to Module 3 of the Technical Analysis 101 series. Once again, I am your coach and educator, Noah Davidson. And you're learning a lot of great concepts here, and you're no doubt solidifying your knowledge base. And if you've made it this far, well, that means that you're ready to dive a little deeper into the price cycles and how they behave more specifically in just the uptrends. You'll recall in the last module, Module 2, that we introduced you the basic concepts of the price cycle and the essential elements of uptrends and downtrends. In this module, module number 3, we're going to build on top of those foundational rudiments with a focus on just the uptrends. And we're going to go deeper into the details and subtle nuances of the uptrends. Now, we're going to review the price cycle and how it behaves in an uptrend and identify exactly how and when uptrends start. And then we're going to incorporate our favorite chart type, candlesticks, into the process and start identifying rudimentary candle patterns that can help us spot tops and bottoms of the cycles. Then we're going to look at the short-term, intermediate-term, and long-term price trends and break down how trends behave on the macro scale, on the macro cycle, as well as on the micro scale, on the micro cycle. And then we're going to go live and look at everything we've learned here so that we can see it in real life in practical application. So let's go ahead and dive right in and have some fun with uptrends and price cycles. Let's take a moment to review what we learned in Module 2 about the price cycles within the uptrend. Now again, we understand that the price cycle starts with the accumulation phase. It then goes into the markup phase, into the distribution phase, and then into a markdown phase. Now in an uptrend, the markup phase is really strong. That accumulation and markup phase will really drive prices higher and higher. And the distribution phase and the markdown phase will actually be pretty short-lived and they won't be as strong. So you'll actually see strong markup phases and relatively mild or moderate markdown phases as the prices establish new higher highs and higher lows. Now, if we were to take and simplify this pattern for you, just to really break it down simply, and understand that that primary growth trend is the driving factor behind it, it would end up looking a little bit something like this. A simplified pattern would show us a good strong buy signal, a reason to buy, when we'd see that markup phase really pushing prices higher, until we see the prices start to slow down as the supply and the demand start to balance out. And we will typically see some sort of a signal candle or a pattern or a group of candles that will identify for us that the price is really slowing down and that we might be reaching that tipping point. Will it have established a higher high in the price? And once we see the markdown phase kick in and we see that distribution roll over into markdown, well, we'll be watching for an opportunity to buy if we believe we're in an uptrend, and that'll typically give us a nice signal candle. Again, some candles or candle patterns, and we're going to get more specific about those in a later segment, in a later training. But this little small candles are going to be what we're looking for. We're going to be looking for that accumulation phase to yield into the markup phase. And once we see that markup phase driving higher, then what we're going to be watching out for is as we establish new highs, we're going to watch for the prices to slow down, to give us those selling signal candles as it makes a new higher high and starts to hit that distribution phase. And then we go into the markdown phase. Again, we don't expect a big markdown, a little markdown. And as it comes down into that old threshold or down around the mean, we're going to be watching for it to give us another series of buy signals. And once we know the prices are low and we're starting to see some accumulation, we're going to watch that accumulation establish a higher low for us. And we're going to see the prices move into that next markup phase. We're going to see it making higher highs and higher lows. Higher highs and higher lows. So that's really the base pattern here. Now that we're establishing higher highs, the question is, well, how high can it go? And we're going to be watching for those same warning signs, that slowing down, the shrinking candles, those small candles. Candle patterns specifically can help give us signals that we're hitting that distribution phase, which then typically, again, now that we've established the higher high, we're in the distribution phase, we're going to see that markdown phase kick in again, and the pattern simply rinses and repeats, and we're off to the races with a new higher low and another opportunity to buy in here. So that's what the basic pattern looks like. Higher high, higher low, higher high, higher low. You get the picture. Now, an uptrend, by definition, starts with a failure of resistance. Again, an uptrend, by definition, starts with a failure of resistance. And so what that means here is, we had a previous resistance zone, a distribution phase, and, we call that price, we call that resistance. We're going to go into more detail on that in a little bit later. When we see the prices here break to a new high, that breakout right there, that's really the indication that we are in a longer markup phase, accumulation phase, marking it up. And we're seeing prices start to run higher and higher. And we're establishing new highs. And then the question becomes, well, where is it going to find a top? And we're going to watch for that distribution phase. So uptrend starts with a failure of resistance. Okay, so now let me wipe off that little marker here. And let's go ahead and move in. So what we're looking for is that stock in the upward trend to, again, break out to the new high, establish a new higher high. I'm going to mark that with an HH for higher high. And then as it goes through the distribution and markdown phase, we had this old selling threshold. So here people were selling, and that old selling threshold tends to become a new threshold for buying. And that's the accumulation phase. We've kind of established this, we understand it. And as we go through the markup phase and it clears and breaks that resistance, it'll start to establish new highs. It'll mark up prices until it gets to a point where you start to see some supply kicking in and we're overextended, and you'll start to see small candles just like this one. And that's a good signal for us. And we're going to get more specific about the candle patterns again in a later training. But we now know that we have established another higher high, HH, and we see the same pattern repeat here. Selling candle, selling into that same zone. We see a buy zone. And if that buy zone can establish a new higher low, HL for higher low, we can see that trend persist. And that pattern, as long as that pattern repeats and persists, we're in essence in an upward trend. Now in the next segment here, we're going to jump in and actually look at it with real candles, kind of a bigger picture, and see how it looks in the context of a bigger trend. So here we have an example of an uptrend. And an uptrend starts with a failure of resistance. You're going to want to write that down. An uptrend starts with a failure of resistance. Now you can see I've got a line drawn here that's showing an old support resistance zone, a price threshold, where you can see prices have stayed above that price threshold. They've broken down below that price threshold. And when they break back up above that price threshold, that's really when it establishes the upward trend. And then what happens next is, as that markup phase continues, you see the market price establish new highs and start to establish new higher lows. So we see the price is now starting to step up. And we see higher high prices breaking out to new highs and then reestablishing new higher low prices at the old high price threshold, so those old ceilings. And you'll see that stair step up, and that stair step up, this is an extremely common pattern. Now, this pattern is really the foundation of the uptrend, that higher high, higher low, higher high, higher low. And you'll start to notice that there's small candlesticks at the bottoms of these cycles and at the tops of these cycles. Again, there's small candlesticks at the bottom of these cycles and at the top of these cycles. Now, we can establish what's called an upward trend here. And you can see I can literally draw a geometric line there, practically a 45-degree angle. And you can see that that's really a classic upward trend line. So you can literally just draw a trend line, and that can be a good way to forecast out the trend zone. And it gives you an idea of where the buyers are likely to step up. Now, this whole trend here is kind of channeling up or oscillating around that mean. And this is, again, another really common scenario. This is what we call a channeling stock or a channeling security here. And you're seeing it just oscillate up and down through that price cycle in the process of a primary upward trend. So what we're looking at here is the macro cycles in the primary growth uptrend. We've got the macro cycle oscillating around that big primary growth uptrend. But you'll also notice that there's microcycles oscillating up and down around the different cycles. And so this pattern holds true on all time frames, whether you're looking at a daily chart or a weekly chart or a monthly chart, or even if you're down on an intraday chart like a day trader would, looking down at a 5-minute chart or even a 1-minute chart, a 15-minute chart, 30-minute chart, you're going to see these same core patterns exist. And what we're looking at here is, in essence, we're seeing that macro cycle uptrend. We're seeing that big macro cycle. And then around the macro cycle, we're seeing the oscillations of the shorter cycles. And then you'll notice that when you go through the corrective phase, you'll see that the declines can be really steep. And then you'll actually see again that it can run sideways for a little bit. You'll actually see a couple of sideways cycles at the top and the bottoms. And that's essentially what we will see, this pattern, this general kind of macro pattern, micro pattern, where shorter term trends oscillate around, the cycles, and then you have big macro cycles that are also oscillating. In essence, trends are fractal in nature. And what it comes down to is the trading psychology is the same, because it's all human beings that are trading these things. So the difference between a day trader and, say, a swing trader isn't the psychology, it's really the difference in their time frame. And the difference between a swing trader and a longer term position trader, again, they're both human beings with the same core psychology. What you're seeing is the different time frame, just there are different expectations of time. And the same thing is true for the long-term investors, where they're looking at that big, they're hoping for long-term growth, really picking stocks fundamentally. But they know that you're going to see oscillations, that you're going to see prices rise and fall and big rises and falls. And then you're going to see the little oscillations up and down on the day-to-day weekly charts. And so we're going to take a couple of look at those, when you're going to see that there's cycles within cycles and trends within trends, and that everything's quite fractal in nature, and you have the big macro cycles and, again, the big and little micro cycles. Okay, now what we're looking at here is both intermediate and longer term uptrend cycles. And the first thing I'm going to do is I'm actually going to draw out the big macro cycle, just kind of what we were just looking at, the picture-wise. You see the big macro cycle. And again, you see the big oscillations behind it. And you'll see the little oscillations behind it. And you'll see those little oscillations. You'll see it, again, moving through the different cycles of the page, the price cycle. And you'll actually see that kind of playing out just like we modeled out just a second ago. So let me go ahead and clear those off. You'll also notice that there's these smaller uptrend channels where you can, again, see those little oscillations around that upward channel. You'll notice the same thing right here. You got a nice little intermediate trend with its own little trend cycle, its own little price cycle from accumulation through the markup phase all the way up to the distribution phase and the markdown phase. And again, there's channels within those trends, and you can see the big macro trend here, big macro trend, big long channel and its own little mean right there in the middle. So again, that's a big macro trend. That's a big macro uptrend, long-term uptrend. And around it, you see, intermediate uptrends and some smaller, shorter-term downtrends. But that's how trend cycles work. And again, you'll see trends within trends, cycles within cycles, and this is true again on all time frames. Let's take another look at some of the other types of trend cycles. Again, you'll see here. Here's that same trend long-term up channel, and that channeling idea. The idea behind the channel here, and what we want to try to do is, the name of the game is try to buy low. You try to buy it somewhere along the bottom of the channel, and then sell high. You want to sell it after it's had a good chance to pop. And so, again, you can see the stair steps where the old ceilings become the new floors, for example, and those become buy opportunities, buy opportunities, buy opportunities. And this last one over here is a buy opportunity with maybe some upward potential. So that's the point of understanding how the trend channel works. And again, you see it when it gets to that target. You want to look to sell, you want to look to sell, you want to look to sell at the top end of the range. So here we're looking at a 10-year weekly chart. We're looking at this big 10-year weekly chart, big macro uptrend. You can see the exact same cycles. I took the liberty of putting a moving average on there. So you see a moving average on the chart, and that's going to serve as kind of the mean. And you can see that kind of oscillations around the mean. and it's kind of a moving mean, but you'll see that general same pattern cycle here on a big weekly, long-term 10-year chart. And you'll see within that, longer term channels. You'll see those big channels for the long-term upward trend, but you'll also see the shorter term channels in the uptrend. And again, it doesn't matter what time frame we're on. This could be a 10-minute chart, and we would see the same basic cycles in these trends. And so, you're starting to get the picture that these trend cycles, again, are fractal in nature, that there's macro trends and there's micro trends, trends within trends. And one last thing you need to know about uptrends before we move on and go live is you need to know that the definition of a true bull market or a bullish uptrend isn't just a little bit of a movement up. We need to see prices move up at least 20% to be, by definition, a bullish market. So again, 20% upward movement for a bullish market. Now, let's go ahead and get ready and go live and see this phenomenon, this chart cycle, this trend cycle on all time frames. Okay, here we are live. I just picked Apple out of a hat, kind of a random stock pick for us, just to show you how these price cycles work. Now we're starting out here on the big macro cycle. And what we're going to do is we're out here on a big 15-year monthly chart. We're going to dial it down in. We're going to look at a weekly chart, and then we're going to go in and look at the daily chart, and then we're going to go in and look at the intraday chart. And you're going to notice that the same core patterns repeat over and over again. And I want to highlight some of these things for you. So again, you can see the general upward trend. Again, we got a pretty well established upward trend. You'll notice consistently, you'll see small candles at the tops and at the bottoms. Small candles at the tops and again at the bottoms. You'll see those consistently. Those are some of the signals we look for. We'll get more specific with those in a bit. You got the top of the channel, of course. And let me go ahead and clear that up. And you can, of course, see it oscillating through that price cycle. And again, that price cycle, right now I would dare say we're at the top of a price cycle probably. And, I'd much rather be willing to buy at the bottom of the price cycle. So that's a big year monthly time frame. Now, let's dial that into the last, say 5 years weekly. And here on a 5-year weekly chart, we see a longer term channel trend right here, the big picture. But then we also see the shorter term channels like you see here. And you can see, again, the whole thing oscillating around the mean. So I could draw the mean up here, and you can see that general oscillation around the mean. And then we can see a period where we saw some downward movement in the trend. We can see it where it even chopped sideways for a little bit. And now we're seeing a nice long channel upward on the big weekly chart. So if I didn't tell you what time frame we were on, you might not know be able to tell the difference. Let me drop down into, let's go down to a 1-year daily time frame here. And here we're just seeing a little bit more detail on the chart we've already seen. But again, we got the top of the channel out here. We got the bottom of the channel kind of down in this ballpark. And again, we see the oscillations up and down. And those price cycles can be relatively volatile in this particular candidate. But again, we see the same cycles and patterns on the daily chart, the same as we saw out on the weekly chart. And now what I'm going to do is I'm going to go take this down into, say, the last 10 days, 30 minutes or so. Let me back that out a little bit further. Let me go 20 days, 1 hour time frame. And here you can see, again, upward cycle. And then recently it's been chopping sideways. The last couple of days it's been chopping sideways. So if we were to dial that down into, say, a 5-day, 5-minute chart, here's the same cycles and trends. Here's the oscillation. And again, kind of around that mean. You can see the downward channel here. Same thing, oscillating around the mean. So that is a multiple time frame analysis. You see trends again within trends, cycles within cycles. You'll see the consistent patterns here. Small candles on the tops of cycles and the bottoms of cycles. And that price cycle playing out over the trend. And just remember this most important thing. The biggest takeaway from this section here, this portion, this module 3, is that the trend is your friend. Always give the trend the benefit of the doubt and trade with the trend. Always trade with the trend. because those accumulation and markup phases are lasting longer in this upward trend right now than are the downward, markdown phases. And so trade with the trend. Of course, if we see a bear market, we'll trade in a bear trend, and that's what we're going to do in the next section is look at the bear trend. So as we get into module 4, we're going to look at downward trends. Thank you for joining us here for module 3, price cycles and uptrends. What we have learned in this module is that there are price cycles in an upward growth trend, that we see cycles within cycles and trends within trends. The trend is primarily defined by higher highs and higher lows, and we look for that stair-stepping progress in the price chart. 3, we see that there are short-term trends, intermediate trends, and longer-term trends. We understand that there are trends within trends and again cycles within cycles, and the short-term and intermediate trends are always contained in the context of the longer-term primary trends. And finally, 4, a bull market is considered established after the market has risen 20%. So again, it doesn't necessarily merit a bull market unless it's gone up over 20%. Please join us for the next module, module 4, where we will discuss price cycles and downtrends. We'll see you then.